This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore.
So you'd be very happy to know, based on a lot of feedback last week, that I think we solved what that clicking sound was in the background.
Knocking, I think.
It's more knocking. Someone called it a clicking. But we actually have a table that we record this at, which had a few loose batteries in the tray. So we're assuming it was the batteries knocking back and forth. So hopefully today has no clicking or knocking.
Hopefully. We didn't hear it when we were recording last time.
No.
I heard it in the audio afterwards, but while we were recording, I didn't hear it.
Yeah, our producer tried to take it out as much as he could, but that was the best we could do. So we apologize for that noise, and hopefully it doesn't happen again. So I noticed you are not carrying your 80-pound backpack back and forth to home now?
It's heavier than that. Yeah, it's kind of scary in the ice.
How much is it?
I haven't weighed it, but it's over 80 pounds for sure.
It's pretty brutal.
I'll carry it home eventually once the ice is gone.
And another update, one of the most common questions I get, believe it or not, is did the raccoons ever come back to my attic? It's so funny how people have heard that and remember it. So I get it all the time. And so I'm peering out my window last week and I noticed, oh no, one of the soffits has been punched out again. So a raccoon broke into my attic again. I had all my soffits secured. I thought they were all secured with screening and screws and everything, but they didn't do one area. For some reason, the company didn't do it. So of course, raccoon busted in there.
Is that included in the 1% estimated maintenance cost for running a home?
No, that was, I paid for it last year, but it's lifetime guarantee. So they came back and put on a new one-way door to make sure that he or she is out, and then they'll come back and fix the soffit up.
Oh, interesting.
So it's actually a good service, but you see why it's expensive to get this done. Like to do it properly and humanely, which of course they do, it's a lot of work. I had to go up and inspect my attic and the crawl space and put the insulation back in place. It's a fair job.
Guaranteed for life, though.
I believe it is.
That's pretty cool.
Pretty cool.
But the raccoons are back.
Anyway, anything to add on this episode?
No, a lot of it was pretty philosophical discussion about life expectancies and what does retirement really mean and how does that affect financial planning decisions. We talked a little bit about the coronavirus, obviously.
Markets, volatility, market timing.
Could not talk about that.
No. Anyways, we'll let you have a listen.
Welcome to episode 88 of the Rational Reminder Podcast.
So I know you have not seen this documentary, but we watched one on the weekend called Betting on Zero. Incredible documentary about Herbalife, which is a company that markets nutritional products like weight loss shakes and supplements. Anyways, it's a company that's been accused of using multi-level marketing techniques. And
isn't that what they do? Accused of, isn't that the business model?
Well, that was my interpretation. I know John Oliver did a great expose on them a few years ago. Anyways, back in 2012, hedge fund manager Bill Ackman thought that it was a pyramid scheme and put on this $1 billion short.
It's a big short.
That's a big short, expecting the market to plummet once this information became public. It ends up that on the other side, Carl Icahn jumped in and was long on the stock. And he was in also big time. So you got this war of the titans of the investment world fighting over Herbalife. And Herbalife was quite adamant that it was not a multi-level marketing type scheme. It sure looked like it to me based on how they presented it. And they were growing like crazy around the world, especially targeting communities who may not have had high incomes and people didn't understand how the business world necessarily worked and maybe didn't understand how it might have been multi-level marketing.
Well, it's kind of the classic MLM motive, right? That's how those businesses tend to play out.
That's how it works. So anyways, the story is about how these two huge managers were on each side of the bet with big dollars.
So what happened?
So what happened was the Federal Trade Commission came out in 2018 and fined Herbalife $200 million, but it was they never called it a pyramid scheme. So they paid the fine. The stock is trading about the same. So I think Ackman, from what I can tell, he was at one point down because the stock went up when he had the short on. He was down $700 million. I think he got out pretty much even, whereas Carl Icahn, I think, made a pretty good return off his investment in the shares. So Ackman is completely out. I've since learned he's completely out of the stock, and it's still trading and the company's still going on, but I think they've changed their business practices.
So it's not an MLM company anymore?
Not to the extent that they would get into trouble, but I don't know today.
Wow.
But to see the vicious fight between these two investors and to watch the company defend it, with Michael Johnson, who was a former head of Walt Disney International, pretty polished guy at the head of this company. He was making like $90 million a year leading this company around the world. And they were adamant it's not an MLM type scheme.
So I guess that's an explicit story maybe about how information gets into prices?
It sure did. With that kind of money, there's certainly a lot of information in those prices.
Just on the Disney thing, did you see that? I think, did Bob Iger step down?
He's still on the board, I believe, but he stepped down as head of Disney.
Huh.
It seemed to be rather sudden. He announced he was supposed to step down next year, but it took effect immediately on announcement last week. I haven't not been able to see any more details.
Yeah, I just saw that headline and I remembered because you talked about him recently in the podcast.
Still a great book. Anyways, other news this week.
Yeah, I can't believe we didn't lead off with this news. That's probably what everyone's hoping to hear. Maybe not because it's the Rational Reminder podcast.
Plus, if you look back in 2 years' time, you may not remember this anyways.
Market dropped if people didn't notice.
A little bit.
A little bit.
Now, we're recording this on Monday the 2nd, so the market was up today. A lot.
Yeah.
But it may not stick tomorrow. But yeah, last week was quite something.
Yeah. Some big back-to-back drops. Some pretty red days.
But do you notice there's always a story to go with the drop? And it's almost like the story is more terrifying than the actual numbers.
Of course.
And it's always this time is different.
Of course. That's the problem, is that this time it is different. Well, supposedly that's how it feels.
But still, for the week, the Dow was down 12%.
So that's a bad week.
It's a bad week. S&P was down 11%. A few days there, 1,000-point drops. And I happened to be traveling last week and, checking in periodically on my phone to see where the market was at. And it wasn't as bad as 2008, but it just reminiscent, being away from the office on a business trip and still checking. It's like, oh my gosh, it's down again. Like, just have that same feeling that we haven't really had.
Well, there were big drops. It's not like they were little, incremental, getting lower and lower. We had days with pretty substantial drops. If we keep having days like that, it would get obviously pretty bad.
But you can see it could get there. Another week like that, you're down 25%. That's a fairly good drop.
And who knows what happens? Like you said, we're recording this on Monday the 2nd. Who knows what happens next by the time the episode comes out? But market volatility is always going to be there.
And a ton of investors in the market today have never seen this kind of volatility.
Yeah. Which is interesting to think about, but it's also interesting anecdotally where I've had many conversations with people who I consider to be exceptionally rational and well-educated on the financial markets, and they're also freaking out, which is like...
Based on the quantum or based on the story?
Oh, it's always the story. If it's just based on the quantum, this was nothing.
And imagine if you didn't see on the news that the market was down 1,000 points, like your house. Can you imagine getting a statement on TV that your house was down 1,000 points today?
Well, that's what, there's a website in the States that does that. People freak out about it.
Or has it been a lot of talk? The Twitter people we follow talking about how I wish I had private equity that wasn't marked to market. I wasn't down at all last week.
That's what people are saying. My private equity is doing great.
Anyways, you did a little bit of research on how bad is it?
I wanted to put the drop that we had into context. So I built a model portfolio just with indexes, not index funds, so no fees. Rebalance monthly, 1/3 Canadian, 1/3 US, 1/3 international stocks. No emerging markets, just 1/3 each in Canadian, US, international, developed. And I use monthly returns. So we mentioned those 12 and 11% drops for US stocks. Those were based on weekly returns.
Right.
I used monthly, just a little bit easier to work with that data set and easier to get that data.
And your data was current to the end of last week?
Yep.
Awesome.
Yep. So using monthly returns, month-end data, the 2020 drawdown being the peak to the trough.
So the peak of this year to the trough of this year, not
so far.
January 1st to the end of February.
Correct. Well, it ends up being that anyway because we only have 2 months of data, but we're going to talk more about drawdowns and
right.
Yeah, the drawdown is the peak to the trough. So the drop for 2020 was 6.8% for this portfolio. So not terrible. And I mean, Canada did not have as much of a drop as the US. I think international actually had the biggest drop of the three. But anyway, on average, 6.8%. So not too crazy.
And then you compare this to the calendar year drawdowns over time.
Yeah. On average, so this is going back to 1970 is where I had data. And on average, there was intra-year. So it's important to describe actually. I built a little algorithm thingy in Excel to pull the data for the maximum drawdown within each calendar year. So from January to December in each calendar year, what was the biggest intra-year drop?
Okay, peak to trough in a calendar year.
But we're not looking at drawdowns across multiple calendar years.
Right.
So on average, intra-year drawdowns, 8.65% on average.
Right.
With a standard deviation of 7.26%. So if we say the drawdown so far this year was 6.8%, that was not as bad as the average drawdown and well within what would be considered normal based on a normal distribution of outcomes. So not crazy at all. The last decade was uncharacteristically good in terms of not having a ton of big drawdowns. From 2010 to the end of 2019, we only exceeded the historical drawdown twice.
So it was only twice a bigger drawdown than 8.65.
Correct. That happened in 2011 and 2018. Keeping in mind, these are month-end numbers.
Right. So there's a little bit of smoothing going on here and you're washing out some volatility.
Yeah.
But still it's meaningful.
So then I looked at what happened in years where we did have drawdowns of various magnitudes. What did the year end up looking like? So for years where there was a drawdown of 6.8% or greater, so that's the drawdown that we've kind of seen here based on the month-end data.
Yep.
The portfolio still returned 2.38%.
On average.
On average.
For the year.
For the year. And 50% of the time, so 50% of those years, there was a negative return. So on average, 2.38%, but in about half, well, in 50% exactly by year, there was a negative annual return in years where we had a 6.8% or greater drawdown.
So 6.8 or worse drawdown.
Correct.
Okay.
So then if we carve some of those out and say, what about only 10% or greater drawdowns? In that case, on average, the year finished. So if there was a 10% or greater drawdown within a year, the year on average finished with a negative 2.4% return. And 67% of the time, in those cases, it was a negative return for the year.
Interesting.
Meaning, obviously, the difference was still a positive return. So negative on average, but still not guaranteed to be a negative
and the
return.
average negative is not terribly negative.
No, not bad at all. And then I carved out the 20% or greater drawdowns. And in those cases, that for the year, the portfolio returned almost negative 15% for the year. And in 83% of years, it did have a negative return.
That's a little more painful.
A little more painful, but we're also not there with the current drawdown. So if we look at past years that have looked somewhat like this year, on average, the outcome's still been positive.
And how many times do you know were there minus 20% or worse drawdowns? Was it a meaningful number?
I have the data, but no, it's not. I didn't write it down.
It didn't happen a lot of times.
Not a ton.
Okay. Now, can we draw actual inferences from this data, or is it just interesting, but potentially not statistically telling?
Yeah, no, there's no real statistical relationships that we can see here other than that what we've seen this year is very normal. I guess statistically that means within one standard deviation of the average.
If you have the ability to look at the data and not know the story behind the data.
Yeah, well, that's the tricky thing is that we have this coronavirus.
And do we know that was the cause? I mean, some people were writing last week that, this was the perfect excuse for people to clean up their portfolios and do some selling.
Do some loss harvesting and rebalance and stuff?
Hey, I'm just telling you what some of the stuff I was reading.
Yeah.
So we had a few calls from people last week wondering if they should be investing now, which it's a great instinct.
Yeah, well, I think we've had two things. We've had maybe people who invested recently. It's kind of funny. Like you think through over time, you'll have cohorts of people that make decisions at the same time. So we'll have a cohort of clients that just happen to invest varying amounts of money, but in some cases, large amounts of money right before a drop like this. And then you have cohorts who just happen to invest right before really good markets. It's kind of funny to see the different experiences that people can have just based on the random outcomes.
But the market's basically back to where it was last fall.
Yep. So the thing that I was thinking about in terms of making investment decisions based on this type of volatility is, well, we know market timing is not a good idea in general, and we'll talk more about that in a second. But with the data set that I had for this portfolio that we were just talking about with the drawdowns, I used that to build out a little, I guess a market timing model. So we took the exact same data set starting in 1970, and we modeled 3 different scenarios. One scenario where we invested arbitrarily at the beginning of January, $1,000 every year. So that's the first kind of benchmark model. And in that case, based on the returns over this time period, you end up with $1.33 million.
So $1,000 a year for 49 years. Okay.
With the returns that this portfolio got over that time period.
Right.
And so that's baseline. Arbitrary, you get your whatever bonus every year and you invest that, and that's your savings for retirement.
Yep.
And then I looked at what ifs, because I had this drawdown data that I'd created, which is actually pretty hard to create. It's harder than you'd think to find the lowest in a big, so there's 600 roughly data points, right, for this data series. So to find the lowest drop, peak to trough in each calendar year, that was hard.
So you had to program it, or you had to go find them?
Programming in quotation marks. It was Excel in-cell programming.
Okay.
But still, it was hard to figure. Anyway, because I had that done, I was like, hey, I can use this to build a little market timing model. So I made another scenario where instead of investing arbitrarily in January, we waited and invested with perfect foresight, or because we have all the data, obviously, invested at the worst possible times. So right before each drawdown is when we made our contributions.
At the end of the drawdown, at the low point.
Well, I did both. So, but for the worst one, it was at the high point. Yes. So right before the drawdown.
I see. I get you.
So worst possible timing for the investments. Instead of ending with 1.33 million, which is what the arbitrary January 1st investor earned, they ended with 1.15.
If you invest at the high point for the year. Okay.
Worst times to invest within each calendar year.
Yep.
And then I figured, okay, what's the best possible outcome? So if you invested within each year at the trough of each drawdown, you ended up with 1.39 million.
So all 3 scenarios are pretty good.
Well, that's what I'm saying. Exactly. So people worrying about, assuming you ought to have a long time horizon. And if you don't, you shouldn't be on all equities anyway. But the impact on timing decisions are far outweighed by long-term market returns.
So the annualized return for the whole portfolio for that period was 9.5%.
Yep.
And if you drop off the 10 best months.
This is the thing, right? Is that in our timing model, wasn't really a timing model because you're still mostly invested most of the time, which I guess is why the numbers are so close.
It's true. All you're really doing is shifting.
Timing your contributions.
Timing that, and that $1,000 over time becomes less and less meaningful, I'm guessing.
Which is what you think about, though. Like if you think about people who were panicking about the downturn recently, in a lot of cases, they're worrying about investing one of their many future retirement savings contributions.
But if you have your whole retirement portfolio in there and you see it go down by 10% if you happen to be all equity, that's painful.
Yeah.
It went down by more than you saved for many, many years early in your savings life.
Yep. No question. No question about that. Yeah. So if we make the assumption that you are not going to stay fully invested with the money and just time the contributions, if we say that you're going to time the whole entire portfolio, where it gets really tricky is that missing a few of the many months of returns. So I think it was 602 months of returns that I was looking at. I stripped out the best 10, not the best 10%, the best 10 of 602. And the annualized return drops from 9.5% down to 7.7.
And that's the months. And I bet you it's probably days of those months that really made the big difference.
Yeah, it's probably true.
Because I've heard stats like a handful of days over a savings lifetime can have a huge impact.
Yeah. So anyway, I thought it was just interesting to see that over the long term, if you're investing your savings, a drop like this doesn't make a huge difference.
Right. But one question that does come up a lot when things like this happen is I think it tests people's dedication or devotion to their asset allocation mix.
I had more than usual, which is, I mean, I'm not a veteran like you are, Cameron, but I've been around here for 7, almost 8 years now. And this is the first time, which is interesting because it wasn't even like in 2019. I guess we didn't really have bigger magnitude drops, or 2018, sorry. But yeah, this was the first time that we had multiple phone calls. Well, I used to kind of brag in the past that we never had clients call us when the market dropped. I guess the market hadn't dropped that much.
And it hadn't. It's true. It had not dropped that much.
But this time I got not a ton, like maybe 5 people that wanted to talk.
But even back at the drop in late 2018, there wasn't the story to go with it.
Yeah, that's a good point. Interesting.
The story is different. The story is, it's a compelling story to worry.
Yeah, that's interesting.
It's a very compelling story to worry.
But what I found most interesting is that of the conversations that I've had about the market drop, most of them have not been about going to cash, not been about getting more conservative. They've been about getting more aggressive.
Yes.
I don't know if that's because people have heard us talking about leverage. I don't know what it is. People are listening to the podcast too much. They're getting too rational. But I found that fascinating. People are saying, should we take the bonds out of the portfolio and go 100% equities now? Or should we start using leverage now? My response is, well, your risk preferences haven't changed just because the market dropped. I mean, maybe that's not true. Maybe they have.
Or people just trying to be opportunistic.
And it would have been, I mean, would have been good.
First day of it would have been great. You're up, 5% today.
As of Monday, yeah. Who knows what it's going to look like by the time this episode comes out.
Monday, the 2nd of March. A lot of days left to go.
But in general, I don't think, and we say this always when we're talking to people about asset allocation, is that you don't want to change your asset allocation based on external factors, like what the market is doing. You base it on life circumstance changes. If you're getting closer to retirement, that's a reason to change your asset allocation. If you inherit a bunch of money, that's a reason to change your asset allocation. But the market dropping 10% over a couple of days, not a reason to change your asset allocation.
Not a reason. No, definitely not.
No. And just on being opportunistic, when the market drops, in other words, when valuations fall, when yields rise, that's not a reliable signal to time investment decisions.
Now, that being said, if you had a severe drop, like back in 2008, where you're down 40, 45% on equities, if you believe capital markets will survive.
Expected returns were higher, but I mean, I guess that means you had cash on the sidelines. Correct. And you missed out on all the returns leading up to it.
Exactly. Yeah, you have time to get the cash.
But we've talked, I think, on the podcast in the past about the Shiller Cape, which is Robert Shiller's market valuation measure, the cyclically adjusted price earnings ratio. That's historically been, of the market timing metrics out there, the most reliable one. Still probably not reliable enough to time investment decisions, but the most reliable one. And the people at AQR, Cliff Asness and those guys, they did a paper a few years ago on using the Shiller Cape to time investment decisions. And you can say this about investing cash. You can say it about changing your asset allocation to be more aggressive, starting to use leverage. Those are all asset allocation decisions, investment decisions that people might base on the market being, in air quotes, low. And the air quotes are actually really descriptive of their paper because they built a market timing model. But what they did in their model that was unique or differentiated their research was they based prices being high or low only on backward-looking history at the time that market timing decision was being made. You can build a market timing model today using all of the historical data. And we know based on the full set of history what was high in terms of valuation, what was low.
Okay.
But the point in their paper was that at a given point, if we're in 1960,
yep,
you don't have all the data out to 2020 to say whether stocks were cheap or expensive in 1960. You only had the data going backward.
Correct.
Leading up to that point.
Okay.
And that makes the Shiller Cape as a market timing tool a lot less effective. If you sort future returns based on valuation with the full data set, it's monotonic. When valuations were lower, future returns were higher. When valuations were higher, future returns were lower. When you have the full data set to look at that. When you don't have the full data set, when you sort based on valuation using only historical data, it's a lot less reliable.
Interesting.
So anyway, there's this hindsight bias built into the idea that you can time the market based on the Shiller Cape. So they correct for this in their model. And they did find, so they looked at data from 1900 to 2015, and they did find that the market timing model added a little bit of value. But the interesting part was that from 1900 to 1957, it did better than the market.
So this is timing to get in and out.
Yeah, they were using leverage on the getting in end, getting more aggressive, and then going into risk-free assets on the safe end when it was overvalued in air quotes. So they found that for the first period, stocks were cheaper and they were invested most of the time or leveraged most of the time.
And that's because in general, stocks didn't do great in that period overall?
Well, they were overexposed to stocks. So it's because stocks looked cheap relative to history.
That's what I mean. So it looked cheaper.
But you think about every time period moving forward, stocks look cheap relative to the past. So from 1900 to 1957, stocks just looked cheap for that time period. And then from 1958 to 2015, their model underperformed the market because over that time period, stocks were generally expensive.
So the model was telling them to reduce their exposure to stocks as time went by, even though markets kept on doing well.
Markets were doing well, but stocks looked expensive.
So is that suggesting that expensive things can get more expensive?
Well, for sure. That's the problem. And that's that hindsight issue with using the Shiller Cape to time the market. People haven't been talking about Shiller Cape as much with this little market correction. It's been all about the coronavirus. But it was maybe in 2018, everyone was worried about valuations being too high. I mean, people still talk about that today. It's one of the go-to market timing talking points. So anyway, in this AQR paper, they suggested that this doesn't really work. The reason being valuations can drift to appear to be relatively expensive or cheap compared to the past for extremely long periods of time. So we could have a full 50 years where relative to the past, stocks look cheap or expensive.
Right. And you also think of that era of falling interest rates over much of that period. So it makes equities look more attractive even though they're more expensive.
True. The other big market timing tool that people talk about is the U.S. yield curve. And that's come up too in this whole coronavirus market decline debacle.
Well, the 10-year treasuries in the U.S. hit their lowest point ever last week, 1.3, 1.2%, some incredibly low number.
Yeah. And so the U.S. yield curve inverted late last year. And within 6 quarters, a U.S. yield curve inversion is usually followed by a U.S. recession. There have been 9 U.S. yield curve inversions, including the one that happened in 2019, and 7 U.S. recessions since 1966.
And every listener knows there's a but coming.
Well, the but is just that you can't use that to time the market. And again, it's kind of similar to the Shiller Cape. It seems like because it's such a reliable predictor of recessions, it seems like that would be a really good market timing tool. Fama and French did a paper on that last year where they, similar to the AQR paper, they built a market timing model that reduced equity exposure when the yield curve inverted. And they did it globally too. It wasn't just the U.S. There's 3 different portfolios from the perspective of a U.S. investor. So there was the U.S., world excluding U.S., and the world including the U.S. They found that, well, there's a quote from them from their paper. The results should disappoint investors hoping to use inverted yield curves to improve their expected portfolio return. We find no evidence that the yield curve inversions can help investors avoid poor stock returns. Well, I mean, what do you expect?
Good enough for me. I mean, if it comes from them.
Yeah, if it comes from them, but they did the analysis. They're not just saying it. I guess that's why they're so credible.
They go on to say the simplest interpretation of the negative active premiums we observe is that yield curves do not forecast the equity premium.
Yeah. This interpretation implies that investors who try to increase their expected return by shifting from stocks to bills after inversions just sacrifice, I love this, just sacrifice the reliably positive, unconditional expected equity premium. Such a Fama French thing to say. Yeah, so my takeaway from that is that, and Fama's written papers on how the yield curve does forecast economic conditions. So they're not saying that's not true. It is. And
just
like I said,
stock returns.
Right. Fama's done some notable papers on that exact topic, that the yield curve does in fact forecast economic conditions or economic activity. But like you said, Cameron, it does not forecast stock returns or the equity risk premium. So trying to use it to time the market, probably not a good idea. No. Like anything, including the coronavirus.
And there's not a single listener surprised by this.
But you know what? I think that it's still useful for people to hear it.
Oh, I agree.
Because we could just keep who said that? Jonathan Clements maybe said that his job was to. No, it wasn't Clements. It was Jason Zweig. His job is to say
That's Clements.
Is it Clements?
It was Clements. There's 20 stories learned how to tell differently.
Yeah, you're right.
Over 30 years of journalism.
Yeah.
Yeah.
It was the same thing here. It's like the market declined. Should you panic? No.
Yeah.
But maybe why should you not panic? Maybe that's the part that's useful to hear. A counter story to the doom and gloom story. I mean, there's not enough data to say anything conclusive. And always, who knows what the future is going to look like. But there have been a couple of pandemics, like real designated, is that the right word? Pandemics, where we have stock returns to see like what was going on. And again, there's no statistical reliability here. This is
simply observations.
Yeah, but it's still interesting. So from 1956, 1958, the Asian flu killed an estimated 2 million people. And there was a big cohort in the US that died from that too. I don't have the number. Not in the millions. It was in the many tens of thousands. Over that time period, 1956, 1958, the US stock market, and I only had S&P 500 data for this. I don't have great data really pre-1970 for other markets. So over that time period, 2 million people died and the S&P 500 returned an annualized 10.87%. And then in 1968, flu pandemic killed 1 million people, not 1 million in the US, 1 million including some in the US. And over that 1 year, 1968, the US stock market returned 11.08%.
Data points.
Based on that data, there's maybe a pandemic factor that we should be trying to exploit.
Okay.
Pandemics aren't funny.
No, there's nothing funny about it. On to our planning topic this week.
Yeah, it ties right in with pandemics.
Yeah. This is one I've been looking forward to for a long time. We've been kicking this idea around to talk about, which is life expectancy. And this comes up all the time in our financial planning meetings and often to eye rolls from clients in the office.
Oh, I'm never going to live to be 96.
It's funny the opinions people have, or other people, I'm going to live to 120, I'm sure of it. And it's founded on opinion, not necessarily.
Well, it's anecdote usually.
Anecdote, exactly.
My uncle died when he was 65 and my dad, whatever.
Anyways, you just don't know. It's one of those risks when you look out into the future, things that are unknown. You don't know how long you're going to live. You don't know what returns are going to be. You don't know what inflation is going to be. Those
are the big ones. You think about what are the main inputs to financial planning of the ones that you don't have any control over, like taxes are a big input, but you have some control over taxes. Spending is a big input and you have a fair amount of control over spending most of the time, unless it's medical stuff, I guess. But the big ones that we have no control over are how long we're going to live, what market returns we're going to get. Oh, and that's a fascinating one. Well, we're not talking about market returns, but just side note. I wish I pulled the data point for this, but in one of Wade Pfau's books, he talks about a cohort of retirees. I don't even remember what the dates were, but it was like 2 years or 1 year apart, where people retiring in one of the years was able to spend, I wish I had the data, but way less than the people that retired just a couple of years before them. And so that market returns piece is huge. And just based on when you retire, based on nothing else, if you saved the exact same amount, just based on the returns that you got while you were saving and when you're retired, you might end up being able to spend way more or less than somebody in a slightly different cohort. So lifespan, market returns, and then inflation, of course, which kind of is part of market returns.
But same goes for life expectancy. I may have used this story before, and I forget who said it on Twitter, but if I told you have a 10% chance the plane you're getting into of crashing, you would never take that plane.
Right.
But I said, oh, you have a 90% chance you'll make it to your destination. You still wouldn't take it, right? But if you tell people in meetings, look, you have a 25% chance of living to 96. Oh, I'll never live that long. Why would I plan on that? Well, it's no different than the plane example. There's a statistical significantly chance that you do live that long.
Maybe people think too that they'll just, they have a safety net in their family, which isn't fair to the family, but maybe that's one of the things people think.
That may be true.
But I think that's...
Or they'll live with their kids or...
But from a planning perspective, I mean, the kids would have preferred the parents to plan around that. Maybe that's a cultural thing too.
Anyway, so we thought it'd be interesting to share with you how we look at this and how we plan for this in our planning, and some things for you to consider when you do your long-term retirement planning.
It has huge impacts on decisions. Like what you're talking about, if someone doesn't plan to live, to that 10% outcome, they might run out of money. But on the flip side, and this is why people roll their eyes when we talk about this, on the flip side, if you plan to be 120 when you die, or you plan to die at 120, means you're going to spend way less.
Yep.
Which also kind of sucks, because if you die at 90, having spent way less and not enjoyed your money, that's not a good outcome either.
Anyways, the standards that we follow is from FB Canada, and they suggest that we use a projection period where the probability of living longer than planned is 25%. So plan to live to the age that you have a 25% chance of living to. So based on StatsCan tables, a 60-year-old has a 25% chance of reaching 94 if you're a male and 96 if you're female, which almost every day we see people shocked by those numbers.
Oh, every time we go through a financial planning exercise, people are for sure shocked. Just as a point of interest, if we scale that back, instead of the 25% chance, if the 50% chance on average, a male's 89 and a female's 91.
Which I think is what a typical life expectancy would be, 50-50 chance, right?
Yeah, absolutely.
And what blew us away, and we just double-checked the numbers earlier, is that back in 1971, those same figures were 77 for a male and 81 for a female to have a 50-50 chance.
Yeah.
Incredible, the difference in life expectancy in just less than 50 years. Incredible jump. Which
is part of this issue. This issue of planning is that you think about past generations where, the retirement plan was to work until you were 65, maybe retire for 10 years, depending on the time period.
Yep.
In the past, it was maybe even shorter than that. And then you die. And that's it.
The sad note in these life expectancies that we just tripped over looking at the data was the life expectancy is slowing now, especially in BC, due to people overdosing on drug use.
That is very sad. The thing that I find staggering about that is that when we look at mortality tables, that might be pushing down average life expectancies, because the younger population of males, particularly in BC, like you said, are dying sooner. But on the longer end, older people are living longer because of improvements in cancer and cardiovascular disease treatments.
Yeah, and I think that's one of the fastest growing cohorts is the people that are really old.
Yeah.
Because you've dodged so many bullets by the time you get to be that age.
But again, like if we're looking at the FP Canada mortality table that they get from Statistics Canada, that might be misleading. Because on average, sure, but then there's this whole cohort of young people that are dying from drug overdoses. If we take those out of the data set, then maybe the average life expectancy is a lot longer.
No doubt.
And if you're not a young person using drugs, then you would not fall into that cohort. So anyway, long life expectancy is a thing to plan for sure. There's another really interesting concept that Moshe Milevsky's written about, just in trying to figure out if your chronological age, so your age in years as we normally calculate time, might be different from your biological age. So your mortality expectations might be very different than your chronological age would predict.
Based on where you live, based on your lifestyle habits. It's also called your inner age, I believe.
You did a little calculator to see where you...
Calculator, yeah. So I'm actually 13 years younger, my biological age.
Wow.
So it asked what country you live in, part of the world you live in, exercise habits, alcohol consumption, how much you sleep as well was in there, how much stress, how much happiness. So I just did a little online tool. And I'm actually 40 years old biologically.
Interesting, but also like there are huge financial planning implications to that finding.
Just added 13 years to my retirement.
Right. But it also puts you in a position where there might be, like we talk about annuities all the time. We still don't do a whole lot of them because I think they're intimidating for people. That's like what Alison Schrager that was on recently said. She as an economist, she loves annuities, but everybody else hates them. But anyway, if you have a biological age that's a lot lower than your chronological age, that almost makes annuities like an arbitrage.
That's exactly what it is.
The insurance company is willing to sell it to you based on your chronological age. If your biological age is much less than that.
Well, because they have a large enough population. They know in a population. You just don't
Malevsky
know.
even says, though, in his paper, he said, well, we'll talk about the paper in a sec, but he even says that insurance companies are going to have to be very careful about underwriting this. Like they might have to start looking at the biological age as well.
Fascinating.
It is fascinating. So he did a paper. Now, a note about Malevsky, his papers are dense. Like they're mathematically heavy to the point where I can't really get through them properly. That's like Fama and French's papers. One of the things I like about them is that they're so clearly written and the models are so obvious in most cases. Anyway, so Malevsky wrote a paper in 2017 titled Retirement Spending and Biological Age. And they explained that the paper is inspired by the growing body of medical literature that has identified biomarkers of aging, which practically speaking offer better estimates of expected remaining lifetime and future mortality rates. That's a big statement. And in really simple terms, what their paper was trying to figure out is he uses the example of the 4% rule, which is based now that 4% rule is a disaster. We're going to talk about that in next week's episode with Wade Pfau. But assume the 4% spending rule, it was designed based on a 30-year retirement period. Say based on your chronological age, you're going to follow the 4% rule.
Mm-hmm.
If you found out your biological age was materially different, it would mean spending less.
Yeah, 4% will drive you too high spending.
Right. And in the paper, Malevsky says that your biological age, and you've noticed this anecdotally, Cameron, your biological age can diverge by as much as 10 to 15 years, you're right in the middle, from your chronological age.
Yeah, I think that for some reason it said mathematically the most it can diverge is 24 years. I don't know where that came from, but I saw that in the notes on the survey that I did.
Huh. So Malevsky in this paper is saying, it's not just like, oh, this is interesting. Malevsky is saying that in order to make rational financial decisions, you need to know your biological age.
And to do it properly, it should be a medical checkup of some sort.
The big
like an
ones,
online survey is not the right way to do it.
No.
My main point is just I'm not suggesting to take that test. I'm not suggesting there's validity. I'm just happy I'm 13 years younger.
That is
for this
good.
one podcast episode.
The thing that Malevsky talks about in the paper is telomere length. And I don't know much about that. I don't know anything about that. But from what I could find just in reading about his research on this is that the telomere length seems to be something that there's a strong indication that it might be predictive of mortality, but it didn't seem like there was anything conclusive yet. Everything had these little disclaimers of like, it seems like.
Okay.
But anyway, that was one of the new inputs. Like, why is this becoming more interesting as a science? That was one of the big ones. But I think that thinking through the planning decisions that this would impact is why it's important.
Yeah.
You just think practically. We talked about annuities. That's an arbitrage. Another angle, I guess, on buying annuities is deferring CPP and OAS.
Yep.
You're effectively buying more annuities by funding your consumption with your portfolio.
Let the CPP pay you for a long time if you're going to live a long time.
But you'd only do that if you have a biological age that's much lower than your chronological. If you ended up, what if your biological age was 10 years more than your chronological age? Then you're not going to defer CPP.
No, of course not. That's my point.
Right. And you're not going to buy an annuity. And I think another big one is asset allocation, where if you've got a really young biological age, you might stay more aggressive in your portfolio. You think about rules of thumb, the 100 minus your age in bonds rule of thumb. Which age? That should be the answer to that statement. But yeah, I think that one of the big takeaways from all of this, and there was an article from Rob Carrick recently that spoke to a lot of these points really well. One of my main takeaways was the concept of retiring at age 65. Your chronological 65 might not make a whole lot of sense.
Which we've said often.
Like we talked about some financial planning decisions, like keeping your portfolio more aggressive, maybe buying annuities, maybe deferring CPP to deal with these long life expectancies. But then you layer on top of that the idea of a biological age. And what if you're even younger? So now you've got a really long life expectancy, and maybe you're actually even younger than your chronological age says you are. It becomes really hard to fund very long periods of consumption with risky assets like stocks and bonds. which is why maybe annuities are interesting. But what's the other thing that you can do? What's the other lever that you can pull?
Work a little bit longer.
You can work a little bit longer.
And so many people enjoy the work. So it's not the end of the world to work longer. We have many clients that work well beyond 65.
And enjoy it.
Have some that work way, way beyond 65 and love it. Just love their careers so much.
It's almost divisive because you think about the whole FIRE movement, which we'll talk more about in a second, but a lot of the perception there seems to be that you should want to stop working as soon as possible. But anyway, let's talk about what Carrick had to say before we talk about FIRE. So Carrick wrote this article, "It's time to stop acting like retirement past age 65 is a failure."
And I couldn't agree more. Why not get a job you love to do that you don't feel you have to get away from? And I think the whole retired 65 goes back to when people were doing jobs that were much more labor intensive. Like I get it, if you're doing heavy labor, you're beat by age 65. No labor in our jobs. There's also a quote in the article saying that later retirement is not a novel concept. Stats Canada numbers show that over the past 20 years, the average age of retirement rose to 64.3 from 61.
And Rob was pretty passionate about this. I'm like critical of society for...
He talked to us 2 years ago in the interview when he was here.
Yeah.
How much he loves what he does.
Right.
As an example. Why not find something you love doing and keep on doing it?
He says that our thinking about the retirement age has been slow to adapt to the realities of society today. And he talks a lot about advice too, where people aren't really giving the advice to continue working. And again, that sounds divisive because the whole FIRE movement says you should try and stop working as soon as possible. So for us as financial advisors to be saying you should plan to work longer.
But it has a huge impact on the plan.
Huge.
5 more years of saving, 5 fewer years of drawdowns.
Even if it's not 5 more years of saving, you can have a saving retirement where you stop saving but earn enough to fund lifestyle. Yep. That has a huge impact.
Well, that happens often.
Yeah.
I'll carry my weight until I have to draw in 5 or 10 years, for example.
Yeah. John Chevreau, who we had episode 35, he was a guest on this podcast. He wrote a book called Victory Lap Retirement, where he talks about just this idea of scale back, maybe draw down on some of your portfolio to start funding some lifestyle expenses, but also keep working and earning an income, doing things that you enjoy doing.
So you want to talk FIRE?
Yeah.
We interviewed last week the producer of the movie Playing with Fire, Scott Rickens, was on. What a great interview. It comes up, I think it's in 3 or 5 weeks. Yeah,
it's a ways up. That was a great conversation. He'd already sort of opened our eyes about FIRE. Well, your eyes. I still haven't watched the movie, embarrassingly. His explanation of what FIRE means to him it gave me a lot of clarity. I don't know. What did you think?
Oh, totally. That's the whole point of the movie, right? Once your values are clear, your decisions are easy. And he's got this buffer he talked about where he's not as stressed about money and he just loves to do what they're doing.
That's a powerful statement. Once your values are clear, the decisions are easy.
And that was a breakthrough he talked about between him and his wife. It's fascinating. Everyone knows I love the movie, but I thought the interview was really interesting.
But in the context of this conversation that we're having about long life expectancies and maybe lower biological ages than chronological ages, this idea of working longer, I mean, you can almost borrow a lot of the ideas that the FIRE movement has developed for people who are not retiring early. If someone's retiring at a normal age.
For sure. And that was so interesting when you opened his eyes up to the PERMA model for happiness, Martin Seligman's model. He hadn't heard of it before, but it totally dovetailed into the FIRE movement.
And I haven't seen Canadian data on this. I've seen US data because Larry Swedrow talked about it in a book that he wrote on retirement. Oh, it's the book that he talked about when he was a guest on this podcast. But he talked about the data in the US where males age 65 or something like that were the most likely to be depressed.
Oh, wow.
I don't know if those are the right exact statistics, but the spirit of it was like that. And it's presumably because they're bored and people retire and don't know what to do with themselves. And so they get sad. But yeah, the PERMA model I thought was, for FIRE in general, but for this discussion in particular, I thought it was perfect. But PERMA is a 5-factor model, not an asset pricing model.
You would call it a 5-factor model.
It is. It's a 5-factor. That's what it is. I didn't call it that. But the factors are positive emotion, engagement, relationships, meaning, and accomplishments. And I think when you look at...
These are the 5 components that lead to happiness.
Correct. This is a scientific model of happiness, which is amazing that exists. But so I think of the 5 factors, when you think about engagement and meaning, you can get those doing, I guess, all sorts of things, but doing work that you love, it's got to be one of the best.
Well, it gets all of them, right? Accomplishments, engagement, relationships, it's all there.
But the key is, and this is the whole FIRE philosophy, is not having to work for a paycheck.
Work for these 5 reasons.
Right.
Money is not one of these reasons.
Correct.
We've talked about that before. Once you get beyond, was it Daniel Kahneman's number, $70,000 or $80,000 of income? Beyond that, there's marginal increased happiness. No matter how much money you make, water's pretty much the same that we're drinking. Cell phone's pretty much the same.
But now you think downstream. So say people agree, like, yeah, that does make sense. I'm going to plan to work, maybe not doing what you're, now I struggle with this one a little bit because I really like what I do when I come to work every day. And I walk to work, which is also awesome. Some people might hate their jobs and they might want to do something different as soon as they can. But if you can find something that you love doing, that you can get paid some money to do, the downstream retirement planning implications are massive. Like we were talking before about how much of an impact it can have if you decide to work a little bit in retirement. It doesn't just mean you can spend more. It doesn't just mean you can retire earlier. It also means that now, as a younger person, maybe with a family and all that stuff, like I get it, kids are expensive. You can choose, if that's part of the plan, to plan to work in the future. You can choose to spend more of your income now. Like that's a big practical implication for a lot of people. And you think about it in the context of the whole retire early movement. And we talk about criticizing the 4% rule for the retire early crowd because it's not designed for a 30-year retirement period. But if you're going to work and earn an income, you might not need to draw that much. You might need 1% from the portfolio to supplement your income.
And you might be thankful to have that if your biological age is 13 years younger.
Yeah. So I don't think it's unreasonable at all to think that the whole concept of retirement is changing based on societal changes. Like the FIRE movement has been a big deal. Just this idea that you don't need to spend money to be happy. And if you actually save your money to get freedom of your time, you can be happier. That's a big deal on its own. But then you layer on top of that, maybe there's a bit of a shift in how people are seeing money and the relationship people are having with money. You layer on top of that these longer life expectancies. And then this idea that you might be way younger or older than your birth date would tell you. You put all that together and the idea of full stop retirement starts to sound kind of crazy.
But if your values are clear, and this was one of Scott's point, him and Taylor, his wife, sat down and listed out the 10 things that give them the greatest pleasure. And all of them were basically free. Going for walks, walking with their daughter, playing in the park, reading.
Yeah. I guess that's the other side of this too, is that we can talk about the idea of working into retirement, but like you just described, spending only on the things that really make you happy, many of which might be free.
And make sure you're in sync with your partner.
Right.
Because he said until he had his eyes opened up to this, they'd never had these kinds of discussions. Anyways, on to bad advice of the week.
Do you think our discussion on longevity was coherent?
I think it was.
It's a lot of pieces. It's a lot to think about. Living longer, your real age being different from your birth date age. Yeah, it's a lot to think about. Practically, it's like someone who's retired and not working, maybe they could be working, but I guess if that wasn't part of the plan, maybe they're not set up to be doing that. But someone who's younger and still saving, if they decide that it is part of the plan to have the skills necessary or whatever to earn an income in retirement, I think the thing that's kind of mind-blowing to me is that they could choose to plan for that and therefore save less now and not shoot for early retirement, whatever that might mean to somebody.
But you still have to be responsible because bad things happen to your health sometimes. And if you don't have enough saved up, make sure you have adequate insurance for your surviving spouses, etc.
Is that a savings burden or an insurance burden? Combination, I guess.
Exactly.
Yeah, it's a big topic to discuss.
Okay, bad advice of the week. and this will be the last time I think we're going to talk about deferred sales charges.
Are they relevant anymore?
Well, they are. You haven't seen this story?
I did see it.
The OSC, Securities Commission, has introduced a series of restrictions on the use of deferred sales charge funds, which is different than the rest of the country, which just blows me away.
It is weird.
So the rest of the country is banning DSC funds outright effective summer of 2022. However, the OSC has planned restrictions instead of an outright ban. So they're going to ban using DSCs to investors who are over the age of 60 years old. Makes sense. Sure, but it should be everyone. They're banning the use of leverage in DSC purchases.
Makes sense.
Does that still happen? Really? Of course, it should be banned there. Capping the account sizes at $50,000. So I guess they're saying smaller clients with perhaps newer advisors can still use DSC funds.
So it's capped at $50,000.
Yeah, account sizes.
So you can't DSC a big account anymore.
Correct.
That's better.
Yeah, I remember back in the day hearing of trades, $1 million trades, getting 5%. So you get 50 grand to write $1 million ticket.
Next day or something too, right?
It shows up right away.
Crazy.
Banning sales to investors with an investment time horizon that's shorter than a fund's redemption schedule. So the schedule is usually 5 to 7 years. However, they're planning on limiting the redemption schedule to 3 years and require that clients can redeem 10% annually without paying redemption charges. And they want to mandate hardship exemptions. So the OSC says the proposed rule is intended to address negative investor outcomes by limiting the circumstances in which mutual funds with a DSC option can be sold and by giving clients greater flexibility to redeem these investments without penalties. Unbelievable to me. And I just saw, just before we came into the studio here, electronic journal that you and I get, WP, which I guess is Wealth Professional. There's quotes in here that just frankly blow my mind.
Were these comments or quotes from an article?
The quotes from advisors in an article.
Wow.
If you're a new guy that just graduated from the CSE course and you're looking to get into the business, you won't be able to survive, said one advisor.
Does one graduate from the CSE course? Serious question.
And another quote goes on to say, the ban is going to deter a lot of younger guys from getting into the business. If you fast forward 10 years from now, when the old guys retire, not me because I'm biologically 40, when the old guys retire, there won't be enough young people coming into the business. I mean, this is just nonsense.
I mean, good. That might sound harsh, but
I mean, the business is very different than when DSE came out back in the 90s. It's very different. That's when the independent channels are just being created. But now there's no need for someone to be starving and living off of DSE.
Other than the pure economics, where it's really hard to start off in this business. But other than that, the barriers to entry are very low. I was kind of making a joke about graduating from the CSE. It's not hard. The information is good, and you're probably going to be better at giving investment advice after writing the CSE than before, but it's very basic.
But is it up to the industry's funds to pay for new people starting out in the industry? Is it their job?
No, that's what I'm saying. The economics.
Why is it the product job to pay for the people to get in the business?
That doesn't make sense.
Here's a thought. If you're going to start up a new business like any other business, how about go have a bunch of capital so you can carry yourself until you're viable in a fee-based world? Or join another practice where the enterprise is already going.
Yeah, that's what I mean about the economics. But the problem is, well, the economics are hard. The solution for the young advisors that are trying to make it on their own, the solutions are DSC, insurance, permanent insurance. That's what pays the bills.
That was also mentioned in the article. It'll force more people to sell more insurance.
Which is crazy. Obviously, I'm biased, but I think that the model that we have of an established business that's fee-based, that has employees that have no sales incentives or performance incentives or anything like that. Like we've made a very deliberate decision to be everybody's on a fixed salary. But that structure to me is so obvious. Like any professional services business is structured the way that this is. Why should it be a sales organization just because we're in the investing industry?
Anyways, that's the last time we'll talk about DSCs.
Is it?
Yep.
I don't know.
That'll be it. Anything else?
Nope.
Thanks for listening.